Good morning. Thank you for joining our daily webinar here at 10 a.m. Pacific time, where we go over your questions and we also cover various topics. Today, we're going to go over your questions, and then we're also going to discuss the solo 401k eligibility rules, contribution rules, the auto contribution credit, and so forth. One moment here, please. Okay, so as always, you can follow the conversation on my solo 401k community. That address is my solo401k.net/my community. We have thousands of members there. It's free to join, so you don't have to be a client to join. In other words, anyone that wants to post questions, they can do so. We also have a great video catalog on the community. We also have a large section of guest blog posts. You can even post your own blog post out there as well. That being said, today's webinar is for informational purposes. We're not going to be providing investment advice, nor do we sell investments. Okay, so what is a solo 401k plan? Well, a solo 401k plan is a retirement plan for the self-employed, which means that in order to qualify to open a solo 401k plan, you have to be self-employed in your own business with no full-time W-2 employees who work 1,000 hours or more. So you can exclude W-2 employees who are not owners, who work 1,000 hours, who work less than 1,000 hours, but you cannot exclude those that work 1,000 hours or more when you're looking to establish a solo 401k plan. The spouse of the owner of the business may also participate in the business. Here's an example of a one participant plan. Let's say just one spouse has a solo 401k plan and she has a self-employed business. Let's say she's a contractor. So under our self-directed solo 401k plan, we drafted to allow for the maximum flexibility under the regulations, not only from a contribution perspective, but also from an investment perspective and distribution perspective. Here's an example of a participant plan. So each separate source requires its own separate holding account. That is a bank or brokerage accounts. So the first one would be titled the XYZ Trust Pre-Tax Bucket. The second one is the XYZ Roth Bucket. And the final one is the XYZ Voluntary After-Tax Bucket. So one plan, 3 separate holding accounts for a one participant plan. Here's an example of a two participant plan where both spouses, for example, are participating in the plan because they both work under the same self-employed business. For example, a limited liability company where they're both working under that LLC, resulting in the limited liability company sponsoring the solo 401k plan, and then each spouse participates in the plan. Hence why this slide here shows a total of 6 brokerage accounts or bank accounts, aka holding accounts under the plan. So just one plan still, but now you have 3 additional holding accounts for the second participant, that is the spouse. And that's how you end up with 6 holding accounts under the plan. You don't have to exercise these buckets right away when you first set up the solo 401k plan, even though we will draft the plan to already allow for these contribution sources so you can make them this year or in future years. Some clients may choose to only make voluntary after-tax solo 401k contributions up to the overall limit for 2025, which is $70,000, for example. So therefore, you would make that voluntary after-tax contribution into the voluntary after-tax bank or brokerage account, and then they'll convert it to the Roth solo 401k, or it can even be converted to a Roth IRA. And if you contribute that full 70,000, talking about 2025 contribution limits, then you will have exhausted your overall contribution limit for the year. Okay, let's keep moving on here. So the solo 401k establishment process, we make it very easy. We have an online application which you would fill out. That's how we collect information to draft the solo 401k plan documents. We then draft those plan documents the same day, generally within hours. We then provide you with the download link where you download, sign, upload, and then you let us know in the next steps whether you want to use a bank or brokerage account to hold the funds. And that's how we're prompted to help you with the setup of the holding accounts. And then the final step is to fund that account, which we'll assess by either helping you calculate contributions and or transferring former employer plans or IRA funds. So some items to consider when opening a self-directed solo 401k is the types of funds you're going to have in the plan, meaning you can make voluntary after-tax contributions, Roth contributions, pre-tax contributions, whether you want to use a bank or brokerage account. Most clients will use a brokerage account because it's one-stop shop. They'll be able to not only invest in equities, but also in alternative investments like real estate, precious metals, and promissory notes, to name a few, through that same brokerage account because the plan is with us. So that's where you can make various investment types. And then you want to consider how many participants will be in the plan. Meaning, okay, am I the only owner in the business? If I'm married, will my spouse work for the business? If yes, then my spouse can also participate in the plan. And you can consolidate your retirement accounts into the solo 401k plan by transferring former employer plan funds, traditional IRAs, former employer Roth 401k funds. The only exception is you cannot transfer a Roth IRA to the Roth solo 401k, and that's a Roth IRA restriction. Some of the items to consider when opening a solo 401k is that the self-employed entity type doesn't have to be a formal entity such as an LLC or an S corporation. You can be a contractor where you file a Schedule C, or maybe a farmer where you file a Schedule F. What matters is that you're doing material services where you're reporting self-employment activity. And the solo 401k plan is a retirement trust. It's a separate legal entity. Therefore, it will require its own separate employer identification number, which we will obtain as part of the setup process. You can also participate in, you can continue to participate in your daytime employer 401k as well and contribute to that daytime employer's 401k. And then if you have a side business, you can also open up a solo 401k plan and also make contributions to the solo 401k plan. There are some limits depending on the type of contribution you're making, whether it's employer or voluntary after-tax contributions. For instance, if you max out your daytime employer 401k up to the 70,000 overall limit for 2025, and you also have a side business and you set up a solo 401k, and you have enough net self-employment income from that side business, you can also maximize voluntary after-tax solo 401k contributions to the solo 401k up to the $70,000 overall limit, regardless if you even contributed to your daytime employer 401k or not. So a self-directed solo 401k puts you in control because you can invest not only in alternative investments by writing a check or by wire, but also traditional investments like equities. Let's talk about some contribution limits. Let me share my screen here. Okay, so here, let me blow this up a little bit so you can see it better. So the contribution limits to a solo 401k plan are very generous when you compare it to a traditional IRA, for example, which only allows for $7,000 annual contributions. So with the self-directed solo 401k plan, you can make employee contributions for 2024, this year, and 2025 by your business tax return due date plus timely filed extension. So for 2024, the overall contribution limit is $69,000. For 2025, it increased to $70,000. So that's the overall contribution limit. There's also a catch-up contribution limit of $7,500 for those who are age 50 or older. That remains at $7,500 for 2025. For 2025, there's a new catch-up contribution amount referred to as a super catch-up contribution. That super catch-up contribution amount increases from $7,500 to $11,250 for 2025. And it's only available to those who are ages 60, 61, 62, or 63. So in order to qualify for that super catch-up, you're going to have to fall within that age range. So if you fall within that age range, instead of contributing $7,500 as a catch-up contribution, you can contribute $11,250. You can't contribute both amounts, of course. It's one or the other. All right. So the solo 401k allows for various contribution types: employee contributions, employer contributions, Roth employee contributions, as well as Roth employer contributions, and of course, voluntary after-tax solo 401k contributions. Give me one moment here, please. Also, let's talk about some other items here, and then we'll turn to some questions here. Yeah, please post your questions here in the chat as they come up, and we'll go over them here throughout the webinar. So with the self-directed solo 401k, you can also do the mega backdoor strategy. It's called the mega backdoor Roth solo 401k strategy. So under that strategy, this slide here explains the steps involved in that mega backdoor Roth solo 401k strategy, where you have to open up a solo 401k plan with a company like my solo 401k Financial, who offers a solo 401k plan that allows for voluntary after-tax contributions as well as conversions. And then you're going to have a separate holding account to make that voluntary after-tax contribution under the solo 401k. So one plan, just a separate bucket. And then that's going to get converted over to the Roth solo 401k or the Roth IRA. And then you'll fill out our online conversion form so we collect the necessary information to process that reporting. And the final step is where we're going to issue the Form 1099-R to the government to report that non-taxable conversion. You also want to understand the solo 401k compliance requirements going forward. We already talked about the eligibility requirements, that is to open a solo 401k plan. Let's talk about ongoing requirements. So each year, there's a reporting of Form 5500 Easy that applies if the balance of your self-directed solo 401k is greater than $250,000. If that's the case, then a Form 5500 Easy will need to be filed. Same thing with Form 1099-R. A Form 1099-R needs to be filed if you process a distribution or a conversion within your solo 401k plan. or outside, or to an outside account. For instance, if you convert, let's say you make a voluntary after-tax solo 401k contribution of $70,000 for 2025, you put that into the voluntary after-tax solo 401k brokerage account or bank account, and then you move it over to the Roth IRA or to the Roth solo 401k. That's going to trigger a Form 1099-R. That's got to be reported to the IRS. Likewise, if you take a distribution, of course, to take a distribution from a solo 401k, you have to meet IRS required triggering events, such as age 59 and a half or no longer being self-employed. But that's, again, for distributions. That's different than conversions. What else here? Let's talk about the solo 401k auto contribution credit. Let me pull up some slides for that. Here we go. So the self-directed solo 401k plan offered by my solo 401k financial, for those who open a solo 401k plan in 2025, they're going to be able to get a $1,500 auto contribution credit. And that's going to be spread out over 3 years in $500 increments. And that's essentially a way for the government to get more individuals, specifically self-employed individuals, to start saving for retirement. So they've decided to subsidize effectively your retirement account, your solo 401k plan, by covering those fees that apply to a solo 401k plan by offering the auto contribution credit. So if you open a solo 401k plan with us this year in 2025, you're going to be able to get a $500 credit. And you're going to be able to deduct that on your business tax return with a dollar for dollar tax credit. And then you'll be able to do another $500 in 2026 and a final $500 amount in 2027 for a total of $1,500. Not all plans offer the auto contribution credit. Our plan does. So typical for solo 401ks from firms like Ascensus, T. Rowe Price, Fidelity, Schwab, Chase, Wells Fargo, ADP, they don't provide that auto contribution credit in their plan documents, nor do they provide the applicable forms. So the plan has to allow for, and there are certain forms you have to sign. And it is available to existing clients as well. It wasn't available, the auto contribution credit wasn't available until the middle of December of 2023 and after. So if you're a client that has a plan with us already prior to the middle of December of 2023, your plan is going to have to be amended to allow for this auto contribution credit. And if you do that here in 2025, you're going to qualify for that $1,500 credit for 3 years. So 2025, 2026, 2027, of course, and $500 increments. So $500 for 3 years for a total of $1,500. What's great about the auto contribution credit is that you're not required to contribute to the solo 401k plan in order to take advantage of that auto contribution credit. You're also not required to contribute in any certain amount. So you can not contribute, or you can contribute any amount you wish up to the overall limit. And you're going to claim that $500 auto contribution credit each year by filing Form 8881 each year for each $500 amount. You can learn more about the auto contribution credit under code section 45 like Tom, notice 2020-68, and also by visiting our website. Let's take a look at a question here we have from Nish. We have set up a solo 401k for C Corporation in 2024 at the end of December, but are planning to make contributions for 2024 by the tax deadline of April. But we have generated a W-2 by the end of January. So do we need to list solo 401k in box 12 of the W-2? We are planning to do Roth, employer, and employee contributions. If so, do we need to add up both employee and employer contributions and put it in box 12? Great question. So let me pull up the page from our website that talks about the contribution, where those are deducted. Let's see here. Give me a moment here. Okay, so let's take a look at that applicable page here, and we'll go over that question here. So reporting contributions. So this page here on our website is a really good tool. It'll explain how to report contributions for all entity types, including the entity you're talking about, which is a corporation. So for a corporation, in your case, we're talking about a C corporation, it appears, not an S corporation. So if it's a C corporation, pre-tax and Roth employer profit sharing contributions are reported on the Form 1120, line 23. So they're not going to be reported on your W-2 if we're talking about employer contributions. That's that 25% amount. So let's say you have $100,000 of W-2 wages from your C corporation. Contribute the right here, what I'm looking at here. So 25% pre-tax employer contribution. Let's say you do 25,000. You're going to report those on your Form 1120, line 23. Similarly, let's say you make those employer contributions as Roth employer contributions instead. So $25,000, same situation. You're going to report that on that Form 1120, line 23. So they don't get reported on your W-2. Let's keep looking at this here. Now let's look at the one that reads employee contributions. So employee contributions, pre-tax, you've got an option as to where to report them. You can report them in box 12 of the W-2, or you can report them on, let me see here. Pull that up here. Let's see. Where's that at here? Oh, there it is. So instead of reporting them on the W-2 for employee contributions, so pre-tax employee contributions, which is that overall limit of what, 23,000 employee contribution for 2024, you can report those on Schedule 1 instead, line 16, whether it's an S Corp or a C Corp. So instead of reporting those employee pre-tax contributions on your W-2, you can choose to report them instead on Schedule 1, line 16. Don't report it on both, obviously, because then you're going to get a double deduction, and that's going to be an issue. So hopefully that answers your question. But yeah, I'm looking at this page here from our website. It's a great page. Titled "How Are Solo 401k Contributions Accounted and Reported?" And you can search this box here on our website on the top right. Just type in there, how are solo 401k contributions reported, and it'll bring it up for you. So hopefully that answers your question there. Okay, let's finish up here going over the webinar here, and then we'll be done here. We'll be back here again at 1 p.m. Pacific time as well. Okay, so just want to cover these last ones here. So we talked about how solo 401k plans are subject to reporting. So our annual fee is $125. That's for being the solo 401k plan provider, which means that we take care of the required IRS plan document updates with the government. But we've also decided to include at no additional cost preparation of Form 5500 Easy as well as filing it. Same thing with Form 1099-R, preparation of that and filing it for our clients at no additional cost. Of course, you need to timely communicate to us because we don't have access to your funds. So for those who timely request this reporting, we'll gladly perform that for you and file it electronically with the government. So since we're talking about Form 5500 Easy, again, that form applies. For example, if your plan year ended December 31st of 2024 was greater than $250,000, the market value, so all of your investments, all the participants' funds in the plan, Roth, pre-tax, after-tax, you add all those together. And if the total value of both spouses in the plan, for instance, if they're both participating in the plan, because remember, it's one plan with both spouses or one participant if only one spouse is participating. You have to add all those funds, aggregate them. And if it meets that greater than $250,000 value threshold, then a 5500 Easy needs to be filed with the government by July 31st of this year. And again, you need to let us know, and we'll prepare that for you for your signature and then file it electronically with the government. So make note of that. Likewise with Form 1099-R. If you timely request that Form 1099-R for any conversions, whether it's pre-tax and plan conversions or voluntary after-tax conversions as part of the mega backdoor, that needs to be reported to the government on a Form 1099-R. If you timely request that, we'll go ahead and handle that for you as well. It also applies to require minimum distribution. So if you're age 73 or older, you need to require minimum distributions from your plan. You need to let us know so we can help you calculate that and also report that. Okay, that takes us to the end of the webinar. I think there might be one more question here. Let's go over that question and then we'll be done for this morning, but we'll be back here again in a few hours. So another question here. We have a C Corp with 200 employees, age 51, that get paid $14,000 in W-2 wages in 2024. Just want to confirm the maximum contribution we can make for 2024. Employee contributions, $14,000 each. Employer contributions, 25%. The corp made a loss in 2024. Is it allowed to make the employer contribution and make a tax deduction on this? I assume no. After-tax contributions can be made. Good question. So number one, what sticks out here is that you cannot contribute more than you make in W-2 wages. Therefore, if you only report $14,000 of W-2 wages, so box 1 on your W-2, you're not going to be able to contribute any more than that. And that's across all levels, whether it's an employee contribution or an employer contribution. So if you decide to treat the entire $14,000 as an employee contribution, you're done. You're not going to be able to have your corporation make the 25% employer contribution because you will have exhausted that $14,000 already. In order to be able to contribute more than $14,000, you're going to have to make more. Let's go back to my $100,000 example of W-2 wages. You could contribute $14,000 of that as an employee contribution, or even $23,000 for 2024. And then on top of that, you can do 25% of 100,000, which is what, 25,000. You add those together, that's well under 100,000. So under that scenario, you can make an employer contribution. But bottom line is, you cannot contribute more than you make if we're talking about W-2 wages for a C Corp or an S Corp for that matter. So that's very important. That even applies for employer contributions. So I know it can be kind of confusing because the employer contribution is deducted on the employer tax return. It still has to be based on W-2 wages, and you have to have enough W-2 wages to support that contribution. So if you exhaust all your W-2 wages already by making an employee contribution, you're not going to be able to contribute that employer contribution. Okay. There we go. Follow-up question. Yes, I'm going to send over that link to that page I was referring to where regarding reporting contributions. Here it is. I just went ahead and shared it. I'm also going to share another good page from our website regarding contributions for corporations specifically. Talks all about those rules as well. So there it is. And let me go to that real quick here as well so you can see it. So here's the other page I was talking about, the corporation page, which I also shot over. This is a good page to look at. We actually did a webinar last week on contributions for a corporation, whether it's an S Corp or a corporation. It was done last Friday, as a matter of fact. So take a look at that. It's got great slides here. It's got a great video there, an infographic that talks about contribution limits. There are frequently asked questions there. So take a look at that. It's a great resource there. Okay, so it's been fun. Again, we're here daily, Monday through Friday, each morning at 10 a.m. Pacific time, and then we're also back the same day for a second go around at 1 p.m. Pacific time. So plenty of opportunities to ask your questions. As always, have a good morning, and we'll see you a little bit later.